Hey guys, my name's Max Convexity. Thanks for tuning into my channel. My dog's name is Jax. He's back there chilling on his dog bed. You know, he's not real interested in the latest ETF news, but that's alright. Today I have a really nice video planned for you guys. There's two old world financial companies that have been around forever, extremely prestigious and blue-blooded, and even they are getting into the covered call space. It's a great time to be an investor. Stick around and we're going to get right in the middle of it. All right, the old school firms we're talking about tonight are Goldman Sachs. It doesn't get much more old school than Goldman Sachs, and BlackRock. And they've jumped in the fray here in the covered call space. And I guess BlackRock's fund, BALI's been around for a while, and I've heard about it a time or two. People have mentioned it to me a time or two, but I really hadn't studied it too much until the past couple of days. But also, we're looking at the new Goldman funds. All right, well, let's start with BALI. Okay, their objective is they say they seek consistent income with lower volatility than the broader U.S. market. All right, and then they say they achieve their objectives by holding long positions in U.S. large cap securities and then writing calls on the index, so the S&P 500, the SPX. These are monthly calls, but they roll them every week, so they do it 4 times a month. But and they actually own the securities. They don't use synthetics like YMAX. They actually own the securities. They also have a kicker on the securities. They own futures as well, just a little bit, like 20% of the portfolio in futures, or one fifth the size of the equities they have is a futures position. All right, so they have a good expense ratio, 35 bips. That's good. Been around since September. That's what I was saying. I've heard of them a time or two, but I can't believe they've been around since September. Anyway, they're doing well, though. They aren't real big. They only have 21 million under management. But what they do is they have 116 positions now, but they use some kind of quant program to weight their positions. They try to obviously choose the stocks that are better and overweight those or whatever. And the good thing about using one of the good things about using the actual securities is you get dividends. They have a lot of Apple in this portfolio, and Apple pays a nice dividend. So they get regular old world dividends in addition to the covered call income. All right. I already mentioned the laddered monthly calls on the index. And I believe they're at the money too. And I watched another video, and that's what the other person said. But I couldn't really tell by the prospectus if they were at or out of the money. It didn't mention. Or if it did, I didn't see it. All right. And the other good thing, here's the thing I really like about this approach, where the company actually owns, the ETF owns the securities and then writes index options. JEPQ does that also. So index options are good for a couple reasons. You have the 60-40 favorable tax treatment, of course. And you have that you don't have to worry about assignment. That's one thing I don't get about FEPI. It's a great company, but they own the stocks, which is good, and then they sell calls on the stocks. That seems to me to be a pain and stuff. I'm sure they do a good job, but I like the idea of owning the stocks and selling it on the index. FEPI, in their defense, though, they get a lot more premium when they pick the individual stocks because they sell them on high volatility stocks. So FEPI's a good fund, don't get me wrong, but I like this approach also. All right, so let's check this out here. Let's check out the old Mr. Tasty Trade engine. Okay, so what they did is on any given time they have anywhere from 20 to 80%, or I'm sorry, from 20 to 50% invested. So I just took 30% invested in the covered call strategy. So I did a back test with just 30%. It's called a 30% override. The typical strategy would just be to sell to sell in even proportions. If you had 1,000 shares to sell 10 calls, at the money, 30 days till expiration, we can run that back test for comparison purposes. This would be your typical program. Been doing this forever. Tons of funds. Most of the funds do the 100% override. Like Defiance and YMAX. All right, so average, we're going to look at the profit per day, 483. We're also going to look at the largest profit. This way, the largest profit was $250,000. All right, now I want to run it with the partial override and show you guys something. So we're just going to try it with a 30% override. All right, look at that. Your average win is much bigger. Or not your average. Your largest win is much bigger. But your profit per day, it doesn't look a whole lot bigger. I did the math on it earlier. It's like 4%. But still, that makes a difference over time. And the reason for the extra 4%, because this is total return down here, this metric is. But of course, the reason the profit per day was higher is because the market drifts up over time, as we all know. And this had 700 shares unencumbered by options, so it's free to appreciate just as much as the market does. So it was only a partial override. Anyway, it's an interesting theory. And they can overwrite to, I think they go up to 75%. All right, here we have BALI's holdings. So they, 8% Microsoft, 7% Apple, almost 4% Amazon, 3.5% Nvidia. I mean, Google, Meta. I mean, it's just a big tech fund. All right, so that's good. But it also has some old, it has MasterCard. I mean, haven't heard that name in a while. But other than that, it's just a big tech fund. And there's nothing wrong with that. This is, Eli Lilly. That's, big pharma company. Anyway, it's good looking. So they concentrate on the stocks they think are going to do best. So hopefully the stocks that you guys like are on here too. Home Depot, AT&T. You don't need an algorithm to tell you that AT&T is going to be a good stock to have in a portfolio of 100 other stocks. All right, so here's the fun stuff though. All right, it looks like the mailman's here. All right, here's the futures. So they have 21 million in stock, 5 million in futures, and yet they override. Oh, I'll show you what they override in a second. Okay, and these are their options right here, and they appear to be at the money, and all their strikes are getting blown through. But of course, the market's been going up. When the market goes up, and we're in a bull market, that's what happens to call options. They get their strikes blown through. But sure, they're still capturing plenty of upside because they had that 70% of their portfolio long. All right, so let's go over here to sheet 2. Maybe it was this sheet. Okay, so down here, I added up the value of the options they sold, and it comes to 8. And that's on 25 total assets, so that's a 31% override. So that's why I did that tasty trade test at 30%. Just to get close to it. That's why I did 1,000 shares. I couldn't simulate it with 100 shares because the minimum options you can sell is a unit of 1, which is 100 anyway. You guys know that. All right, so now let's look at the JP Morgan funds. But BALI's definitely interesting. It's a good fund. Then I'm going to compare them all at the end of this. The Goldman Sachs funds are also, they got some really good ideas. All right, lots of times these funds, or I should say lots of times, I saw one video where somebody compared them to JP Morgan somehow. But yeah, and that's a fair comparison. And especially given that their initials are very similar. These funds are all trying to copy each other. When I was writing the slide, I said incorrectly compared. But no, it's not really incorrect. It's just these guys, unlike JP Morgan, there's a couple of strategy differences. That's all I was going to say. For one thing, the Goldman funds, they have a NASDAQ fund and an S&P fund, but they both of the funds own the entire index. Unlike the JP Morgan funds, which pick and choose stocks from the index, just like BALI does, just like that BlackRock fund does. These guys just own the entire index, more like Defiance does. Okay, these guys sell indexed cover calls, but they vary the percentage of the overwrite as well, and they can go from 25 to 75. All right, but because they're index calls, and it's also algorithmically driven or quant driven, so when it's favorable to write options, they write options. When it isn't, they probably don't. But they let the computer tell them. So with the index options, of course, just like last time, these guys have no assignment risk and favorable tax status. Okay, they say their goal statement says the Goldman Sachs NASDAQ 100 Core Premium Income ETF, the fund, seeks current income while maintaining prospects for capital appreciation. And they do get a lot of capital appreciation. And so does BALI. That's both with these funds. That's kind of what their deal is. All right, so the management fee on this one is actually 29. On BALI, I think I went through it and forgot to say it, but it's actually 35. They're both very reasonable, but I believe BALI's a little higher. This one has 35, but then they mark it down here, fee waiver. Anyway, this is your S&P one, GPIX. It's the S&P 500, of course. A lot of funds follow that index. So this one's bigger than BALI. It has 35 mil under management. And then there's their NASDAQ fund. It's been around since October 24th. All right, here's a comparison that I did. And you can see performance-wise, these guys are right there together. I was noticing, though, this only is for a fourth of a year. The Goldman Fund, the S&P Goldman Fund, GPIX, has paid 93 cents per share in dividends out. So, you annualize that. What is that? That's $3.16 or 72 cents. The $3.72 on a $39, well, it's $45 now. $3.72 on 45, is that about 8%, 7%? Pretty good, but BALI, is paying a little less. To 73, and you annualize that, that's 280. That's actually 292. 292 on a $27 stock is a little better. It's more like 10. Getting close. All right. So this chart isn't really quite fair for BALI because when the Goldman funds were IPO'd, was right at the perfect time to IPO a fund. These guys came out on October 26th. That was the low of the last bear market, or the last move down. That was a pretty vicious move down in September and October. 10% move down. Anyway, pretty quick too. October's always dicey. Anyway, this fund was 3.5% in the hole, and I can't figure out how to make it all on the same, in the same comparison. So anyway, but even after you give BALI 3.5%, and this is total return, the Goldman funds are doing better, but they're all doing great. I mean, and it's a short horizon. It's been in one of the biggest ripping bull markets in recent memory. To go public October 26. I mean, the luck these guys have. And then their funds up in a quarter year, 20%. That, they annualize it. They won't, but they'd be up 80% if they could annualize this performance. They're just killing it. Killing it. All right. Like I say, they won't have the downside protection. There's always a drawback when you get a lot of upside. They don't sell as many calls. The sold calls give you a buffer because of the extrinsic premium you earn, buffer your downside returns and your upside returns. But anyway, these funds are upside monsters. Yeah, but you add them all three together, and I think they have about $100 million under management between all three funds. I can't understand why they're more popular, other than the fact they don't have the eye-popping yield numbers with them. But there's nothing wrong with these funds, especially if you're a bull. These are great bullish funds. And 10% is not bad income. 8%, 10%. I mean, that's what JEPQ paid 7.9 this last month, I think. It's good income. I mean, depending on your needs. Yeah, but so the other thing these guys have in common, unlike a lot of the other funds, is they do the dynamic overwrite. And I really like that. I think that's a cool strategy. Because I'm assuming and I'm hoping we'll see how they perform. Maybe they will have a lot of downside buffer because maybe their algorithms will have them start writing calls, as much calls as they can when the market goes down. Because that's when when the volatility goes up, you catch more extrinsic. So maybe I'm not giving these guys enough credit. We'll see how they do in the down market. But these funds are just upside monsters. All right. And then BALI throws in the futures component. I mean, these are going to be upside monsters. All right. Hey, remember, this is just a guy talking on the internet, just like two guys talking. I was talking to my neighbor Mark just a minute ago, not about ETFs, about other stuff. But anyway, it's just, it's just like two buddies talking. It's not financial advice. It's just for entertainment and education. Hope y'all learned something. It's been good talking to you. Don't forget, like and subscribe if you don't mind. And I'll talk to you later.